Okay, so you want to own a bank. Picture it for a second. Your name above the branch door. Deposits flowing in every morning while you collect interest on loans you issued months ago. The vault. Businesses lining up for capital only you can provide. Farmers, developers, small manufacturers, all of them needing you. And honestly, it's not a bad picture. That's what this looks like from the outside. You don't own the money. You never did. Every dollar sitting in that vault, every balance in every checking account you hold, every certificate of deposit you've issued, that is a liability on your books. You owe it back, on demand, to people who trusted you with it, and the loans you made with that money, the 30-year mortgages, the 5-year business lines, those are locked. They cannot be recalled. The moment the trust cracks, even slightly, you have borrowed short and lent long, and that gap is where banks go to die. Some banks navigate that gap for 100 years and build genuine, lasting wealth for every generation of owner. Some banks look healthy on every metric regulators measure and collapse in 48 hours when something nobody priced in finally shows up. By the end of this, you will understand exactly what separates those two outcomes and why the answer has almost nothing to do with the number everyone uses to judge a bank's health. Let's start with what you're actually buying. There are roughly 4,500 FDIC-insured commercial banks operating in the United States right now. They are not the same animal. Community banks, institutions with somewhere between $100 million and $2 billion in assets, make up the overwhelming majority of that count. Locally owned, locally operated. They hold roughly 14% of total U.S. banking assets, despite representing over 90% of all charters. Regional banks, $2 billion to $50 billion in assets, are a different business entirely. More product lines, more regulatory complexity, more sensitivity to capital markets. And then there's the de novo path, starting one from scratch. Regulators will require $20 to $30 million in starting capital before you accept a single deposit, and they'll expect you to lose money for years by design. Fewer than 80 new charters were approved in the entire country between 2010 and 2022. That door is narrow because the charter itself is the point, and we'll get to exactly why in a moment. The Medici family ran the most powerful financial network in Europe for nearly a century on the same basic mechanism we're about to describe. J.P. Morgan personally stopped a national financial panic in 1907 by locking bankers in a room and refusing to let them leave until they agreed to backstop the entire U.S. financial system. Banking is serious. Banking is generational. But those men understood something most people buying banks today have not fully absorbed. The thing you are buying when you acquire a community bank is not a building full of money. You are buying a charter, a government-issued license to do something almost no one else is permitted to do. You are buying the legal right to accept federally insured deposits and deploy them as loans at a spread. That charter is the moat. That charter is the asset. The money inside the building belongs to someone else. And here is where everything most people believe about banks starts to come apart. The architecture that made that charter valuable, the federal deposit insurance that lets depositors sleep at night and keeps the trust intact, was not inevitable. It was a decision. One specific man made it in 1933. Carter Glass, the Virginia senator who had spent 30 years watching bank runs destroy local economies, co-authored the Banking Act of 1933 and did two things that defined American banking for the next 9 decades. He created the FDIC, the Federal Deposit Insurance Corporation, which guaranteed individual deposits up to a fixed limit and fundamentally changed the psychology of leaving money in a bank. And he drew a legal wall between commercial banking and investment banking, separating the institutions that held ordinary deposits from the ones making speculative bets in securities markets. His fear was specific, that speculative losses in investment arms were triggering confidence collapses that destroyed depositors who had nothing to do with the speculation. The wall glass built held for 66 years until the Gramm-Leach-Bliley Act tore it down in 1999. The FDIC he created is still the reason your deposit franchise is worth anything at all. Without it, the trust that makes the entire spread mechanism work simply does not exist. Now let's talk about what it costs to get inside the door. A community bank acquisition in the $100 million to $500 million asset range typically trades at somewhere between 1.0 and 1.5 times tangible book value. Tangible book value is what the institution is worth if you stripped out goodwill and just looked at hard equity on the balance sheet. A bank with $100 million in assets might carry $10 million in equity. That's a 10-to-1 leverage ratio, which in any other industry would make lenders nervous and insurance companies refuse to write the policy. In banking, that ratio is called normal. At 1.2 times book on that $10 million equity base, you're paying $12 million to acquire the institution. But here is where the inherited trap lives, and almost no buyer prices it correctly going in. That loan portfolio you just acquired, the mortgages, the agricultural lines, the commercial real estate notes, was underwritten by someone else, under assumptions that may no longer hold. Every acquisition comes with a due diligence process where outside auditors examine the loan book and estimate expected losses. Those estimates are educated guesses based on borrower credit histories and collateral valuations built on market conditions at the moment of examination. If rates move after closing, or local real estate softens, or a major employer leaves the bank's primary market, the loss estimates you bought against are now fiction. Silicon Valley Bank, to mention it once here for a reason we'll return to, held over $100 billion in long-duration bonds and mortgage-backed securities purchased when interest rates were near zero. That fact was in every public filing. Nobody was treating it as a warning. The inherited trap in a community bank acquisition doesn't always look that dramatic. Sometimes it's a $3 million agricultural loan to a single borrower who has quietly been rolling the balance for 4 years because the previous CEO went to high school with him. Sometimes it's a concentration in commercial real estate that looks diversified until you realize 7 of the 12 properties are within 3 miles of each other and share the same anchor tenant. The price you paid was for the bank as described. What you actually bought is the bank as it is. Now, let's build the revenue picture. A community bank's core business runs on the net interest margin, the spread between what it pays for deposits and what it earns on loans. That concept, the spread, is the entire engine. The national average net interest margin for community banks has historically run between 3.0 and 3.5%. On a $500 million loan portfolio, 3.2% net interest margin generates roughly $16 million in net interest income per year before any other costs. That is the machine. Everything else is either fuel or drag. The second layer is fee income, service charges, wire transfer fees, safe deposit box rentals, overdraft fees, ATM surcharges. A community bank running $500 million in assets might collect between $1.5 million and $3 million in non-interest income annually. Recurring, and it doesn't require any new credit risk to earn it. The third layer is mortgage origination income. Community banks that originate and sell residential mortgages into the secondary market, typically to Fannie Mae or Freddie Mac, collect an origination fee on every loan they close. In a strong purchase mortgage year, a mid-size community bank can generate $2 to $4 million from this channel alone. In a high-rate environment where mortgage volume collapses, that same line can fall to almost nothing. The fourth layer is the one most buyers underweight in their projections. Trust and wealth management. Community banks that run a trust department, managing estates, administering retirement accounts, providing fiduciary services to local businesses and families, earn fee income that is almost entirely divorced from interest rate cycles. A trust department managing $200 million in assets under management at a 75 basis point annual fee generates $1.5 million a year that doesn't move when the Fed raises rates. Most community bank buyers either don't look for this capability or underinvest in it once they own the bank. The ones who build it end up with a revenue stream that smooths out every other line on the income statement. Now, here is the number that looks most reassuring and is in practice the least useful metric for understanding whether a bank survives: the Tier 1 capital ratio. Regulators require community banks to maintain a Tier 1 ratio of at least 6% to be considered adequately capitalized. Most community banks run between 10 and 14%, well above the floor. Silicon Valley Bank's Tier 1 ratio was above 15% in its last healthy reporting period. That number told you the bank had more than enough equity cushion to absorb loan losses. What it didn't tell you was that the bond portfolio held against that equity had lost roughly $15 billion in unrealized market value as rates rose. Losses that didn't appear on the capital ratio because of an accounting election that let the bank hold those securities as if they'd never be sold. The number everyone was watching told you almost nothing about what was coming. The number that actually mattered was duration risk in the bond portfolio. Almost nobody outside the bank's treasury desk was looking at it. Let's talk about what it costs to run this machine. The largest single operating cost in a community bank is personnel. Salaries, benefits, and incentive compensation for branch staff, loan officers, compliance teams, and senior management typically represent between 55 and 65% of total non-interest expense. A bank with $500 million in assets might carry $8 to $12 million in annual payroll costs. Technology is the second major line, and the one that has grown most dramatically in the last decade. Core banking software, the system that runs deposits, loans, and customer records, is typically licensed from one of three dominant vendors: FIS, Fiserv, or Jack Henry. Contracts with these providers run 5 to 10 years, carry significant termination penalties, and are notoriously difficult to exit or renegotiate even when the platform is underperforming. Annual technology costs for a community bank in this asset range run between $1.5 million and $3 million. Add cybersecurity infrastructure, regulatory reporting software, and digital banking platforms customers now consider basic, and that number moves higher every year. Regulatory compliance is the third major cost center, and it is the one most prospective buyers dramatically underestimate. Community banks file with the FDIC, their primary state regulator, and if they hold more than $10 billion in assets, directly with the CFPB. Annual examination costs, compliance officer salaries, BSA/AML monitoring software, fair lending audits, and third-party compliance reviews together represent somewhere between $500,000 and $1.5 million per year for a bank in this size range. That cost does not decline in bad revenue years. It goes up when regulators find something they don't like. But the cost that matters most, the one that turns a profitable-looking bank into a survival problem, is not any of those. It is the cost of funding itself. A community bank funds its loan portfolio primarily with deposits. Those deposits are callable. The depositor can walk in on any given Tuesday and ask for the money back. The loans made with those deposits cannot be recalled on that same Tuesday. They are contractually fixed for months or years. This structural gap, borrowing short to lend long, is not a flaw in the banking model. It is the banking model. It is also the precise mechanism that makes every bank on earth one confidence event away from a problem that no capital ratio can solve. When deposit costs rise, when the Fed funds rate moves, and suddenly your depositors can earn 5% in a money market fund instead of the 0.5% you've been paying them, your funding costs move faster than your loan yields. The spread compresses. The engine runs lean. If it compresses enough, It stops generating income entirely, while the fixed-rate loans you issued at 3.5% sit on your books for another 27 years. That is not a hypothetical. That is 2022 to 2023. That is what happened to the bank we mentioned earlier. Silicon Valley Bank was, by almost any measure, a remarkable success story for the first 4 decades of its existence. Founded in 1983 in Santa Clara, California, it built a franchise almost no other bank could replicate, a genuine specialization in serving venture-backed technology companies, their founders, and the investors behind them. By the end of 2022, SVB held roughly $209 billion in total assets. Here is the number that should stop you for a moment. SVB's deposit base grew from $62 billion at the end of 2019 to $198 billion by the end of 2021. That is a tripling in 2 years, driven almost entirely by the flood of venture capital pouring into tech startups during the pandemic era. A bank that size absorbing that volume of deposits that fast has exactly one problem. Where do you put it? Loan demand from its clients could not absorb the volume of new deposits fast enough, so SVB did what banks legally do. It bought securities. Primarily, long-duration bonds and agency mortgage-backed securities, purchased between 2020 and 2022 when interest rates were at generational lows. By the end of 2022, SVB's securities portfolio stood at roughly $120 billion, about 57% of its total assets. Most of that portfolio was classified as held to maturity, which meant unrealized losses didn't flow through reported capital ratios. When the Federal Reserve raised the federal funds rate from near zero to over 4% across 2022, the market value of those bonds fell sharply. SVB was sitting on roughly $15 billion in unrealized losses by the time the situation became public, against total tangible equity of approximately $11 billion. The losses were larger than the equity. The bank was technically insolvent on a mark-to-market basis before a single depositor had asked for anything back. The depositor base made the situation terminal. SVB's deposits were overwhelmingly from venture-backed companies and their investors, sophisticated, digitally connected, concentrated, and uninsured above the FDIC's $250,000 limit by an extraordinary margin. When SVB announced on March 8, 2023, that it had sold $21 billion in securities at a $1.8 billion loss and needed to raise new capital, the news spread through the venture capital community in hours. Prominent investors advised portfolio companies to withdraw funds immediately. On March 9th alone, customers attempted to withdraw approximately $42 billion. The bank could not meet those demands. By March 10th, the California Department of Financial Protection and Innovation had seized the institution and placed it in FDIC receivership. SVB was not undercapitalized by conventional measures on the day it failed. Its Tier 1 ratio had looked fine right up until it didn't matter. It was destroyed by the combination of asset-liability duration mismatch, a concentrated depositor base with no behavioral diversity, and a rate environment nobody had priced into the held-to-maturity accounting election made 2 years earlier. Carter Glass spent his career trying to prevent exactly this kind of collapse. The wall he built in 1933 kept speculative losses away from ordinary depositors. The accounting election SVB made in 2020 hid speculative losses inside the capital ratio until there was nothing left to hide them behind. So who actually makes money in this business? The honest answer is not the buyer who walks in thinking they are acquiring a stable income-producing machine. The buyer who wins understands that what they own is a federally chartered spread capture vehicle with a moat nobody else can legally replicate, and they manage it accordingly. Warburg Pincus, one of the largest private equity firms in the world, acquired a significant stake in Santander Consumer USA in 2011 and structured the position through a holding company that allowed them to capture the spread mechanics while managing capital ratios at the entity level. Their exit multiple when Santander Consumer went public in 2014 was roughly 3 times invested capital on a 3-year hold. That is not a lending return. That is a financial engineering return built on top of a spread capture chassis. More broadly, PE-backed bank acquisitions structured through bank holding companies in the post-2008 FDIC-assisted acquisition programs produced average returns of 20 to 30% over 5-year hold periods for buyers who understood the spread mechanics at a level most community bank management teams had never modeled. The FDIC was essentially subsidizing the education of sophisticated capital at the expense of failed institutions. The other winner is the long-tenured community bank with a genuine deposit franchise, a base of core deposits that are sticky, low-cost, and behaviorally stable regardless of rate cycles. A bank that has held local business checking accounts and municipal deposits for 30 years pays far less for its funding than a bank competing on certificate of deposit rates to attract money that will leave the moment a competitor offers 25 basis points more. The deposit franchise is worth more than the loan portfolio. The loan portfolio can be repriced, restructured, or sold. The deposit franchise took 30 years to build and cannot be acquired for any price once it's gone. The honest verdict on owning a community bank looks like this. In a good year, stable rates, healthy local economy, well-managed loan book, net interest margin holding around 3.2%, a $300 million asset bank generating roughly $9.6 million in net interest income, plus $2 million in fee income, minus $8 million in operating costs, produces a pre-tax profit of somewhere between $2.5 million and $4 million. Return on assets around 1%. Return on equity somewhere between 8 and 12%. Real, repeatable numbers for a well-run institution. In a bad year, rate shock, loan losses materializing from a portfolio you inherited and misjudged, a local employer closure that damages half your commercial book, that same bank can produce a net loss of $3 million to $6 million while still being technically adequately capitalized by regulatory definition. The difference between those 2 years is not the bank's size. It's not the charter. It's the quality of the deposit franchise, the duration discipline in the securities portfolio, and the honesty of the loan review process before and after acquisition. The one uncertainty this picture cannot fully resolve: rate environment. Every projection here shifts meaningfully, depending on where the Federal Reserve is in its cycle. A banker who tells you they've fully hedged that risk is either running an unusually sophisticated treasury operation or is not telling you the complete truth. A bank is not a building full of money. It never was. It is a machine that borrows trust from millions of people, deploys that trust as capital, and earns the spread between what trust costs and what capital returns every single day, without ever letting the two sides of that equation fall out of alignment long enough to matter. Carter Glass understood that the trust was the asset. SVB forgot it. The owners who remembered are still cashing dividend checks 20 years later. Go back and read that opening picture. Your name above the door, deposits flowing in, money working while you sleep. None of it was wrong. All of it was incomplete. The business is the gap. Manage the gap, or the gap manages you.